5, 4, 3, 2.
Good morning and welcome to Trade Talks. I'm your host, Jill Malandrino, global markets reporter at Nasdaq. And joining me for the RIA monthly strategy update is Chris Englebert of Beirne Wealth Management. It's been quite a year for equities. Wow, 20%, 25%, and 30% for the S&P, Dow, and Nasdaq respectively. And it really has been a record banner year for stocks. I mean, what else do you say about that?
Yeah, Jill, it's one of those things where expectations coming into the year were very muted, and then we get to the end of the year and people have a lot to be thankful for because the returns have been much, much better than anybody expected for 2017.
Yeah, well, if you take a look at the three-year chart of the S&P 500, you could just see that how that momentum certainly continued into the end of the year. And I know it's been thought this was predicated on tax reform and anticipation of the bill, but you know, I don't know. Economics and fundamentals are actually quite strong.
Yeah, so far everything's been looking good. I mean, now one of the things is that there's a lot of forecasts that are coming out for 2018. Mm-hmm. And again, what's very interesting in our business is that many of the analysts have what I call very linear thinking that, hey, if 2017 was good, 2018 is going to be even better. And we started to see some flattening out. Obviously, our next chart's going to be the Nasdaq. Mm-hmm. We started to see some flattening out of the tech trade later in the year. It looks as though valuations are going to begin to matter, and we actually think that we're entering into a period of time very similar to the 99, 2002. Not saying that we're going to have a big tech blow up, mm-hmm. but during that period of time, leadership changed quite dramatically.
Right, well, I mean, let's also take a look at that NASDAQ comp chart because it is really quite impressive, but it could perhaps be not that you'll see a surge of volatility into the market, but perhaps sector rotation. Yeah. Which is not a bad thing.
No, it's not a bad thing. I mean, and that's what's been extending the bull market. Obviously, mm-hmm. we've been dominated by technology this year, number one performing sector out there. It looks as though the financials now with tax reform are going to start pulling up and helping out, obviously, especially the S&P 500. But again, we get a lot of linear thinking that, hey, if 2017 is good, 2018's got to be even better. And we're being cautious coming in the new year.
Yeah. Again, to have that 20, 25%, and 30% gain in the major averages, that's going to be tough to replicate. But Russell 2000, also the smaller cap names, based on this tax reform, also had a decent year. Yeah,
it looked as though the Russell 2000 was really going to pull back, and then when tax reform caught legs, obviously it really took off and did extremely well. This has been a large cap driven market. And it looks as though, from a liquidity standpoint, since there's so much more liquidity in the big cap stocks, mm-hmm. and when money just flows into the market via ETFs or index funds, it's much easier for those managers to buy those large cap stocks than the small cap stocks.
Well, let's take a look at the German DAX because international and even emerging markets have been outperforming as well. What's your take on that?
Yeah, I mean, the beginning of the year, it was all about China. Mm-hmm. Now we're seeing the DAX begin to pick up, and it looks as though in 2018, from a global valuation standpoint, that the international markets could finally have their heyday versus the U.S. markets. Very similar back to the 1980s when the Japanese stock market was the predominant global stock market. You know, it looks as though 2018 we might finally be getting to see some change in leadership.
All right, and how about let's take a look at the bond market, the 10-year Treasury.
Yeah, interesting thing happening there. I mean, if you remember last fall after the election, we saw a 10-year yield spike. They came down all year long, and then the third and fourth quarter of this year, they floated back up. Now, the real question is going to be is if we, again, using that R word, recession, which mm-hmm. nobody's expecting, and it's one of the things that we think investors have to think about is what could possibly go wrong. Mm-hmm. So is the 10-year going to make a move, pro-growth move, tax reform to 3% and finally break higher? Or if you have a recession, is it going to go to 2%? And investors are kind of straddling the fence right now, from that standpoint.
Well, crude has been pretty interesting this year as well. There was a significant rebound, and that for sure, even breaking through that $40 to $50 range.
Yeah, absolutely. And I think what's happening with the crude market, it could possibly be taking the baton from the S&P 500 mm-hmm. and be the next unrelenting market higher. It's broken through some significant thresholds. It touched 60 the other day. Our forecast, it looks as though with demand out there and with the prices that, crude could work its way higher.
All right, and for the second segment of the show, let's focus back on outlook. We had 12 out of 12 positive months in 2017 for the S&P 500, and you had alluded it could be a linear market where 2018 could reflect what 2017 was. I don't know. Again, that's going to be a real tough performance to overcome. I know corporate fundamentals are good. I know the economy is improving a bit, but we also have a new Fed chair coming in this year. We're also going to have more interest rate hikes. There's also speculation out there that housing market is a bit stretched too. I mean, do you really think it's feasible to get those double-digit returns?
Yeah, it's going to be tough to follow up on a year like 2017, but I call 2018. So 2017, our theme was kind of the year of expect the unexpected. Well, we didn't really get anything unexpected. I mean, we saw the rate hikes happen. The market continued to grind higher. Well, now we're looking at 2018 where the unexpected could finally come back. I mean, one of the things that concerns us is ad nauseum, people have been talking the last 18 months about low volatility, et cetera. There's $2.1 trillion in short volatility ETFs in the marketplace. I don't know what it's going to take to roll those off, but anything could create more volatility than what investors have been used to in the last 14, 15 months.
Right, especially with the VIX trading at historical lows. And it'll be really interesting to see what investor reaction will be like should we get some vol back in the market. And if you think about it, there's a generation of traders out there, let's say over the past 8-9 years, have never experienced a high vol market. Think of all the programs that have been written around, all the algos that have been written around this uptrend in the market. Who's to say?
It's been truly unprecedented, and so again, that's why I say many traders, investors get linear thinking that, hey, if things are good, they're going to get better, they're going to keep getting better, and then, we think 2018 valuations are going to matter. At some point, people are going to say, why am I paying so much for that particular company? And if you see some companies beginning to misstep and not deliver, it could be a big wake-up call for the markets in general.
And you were mentioning this before, recession. What if there's a recession? And I've heard a couple of analysts start to talk about that. You're seeing some of them put reports out there that they expect it just because it's part of that cycle or like in that 8-year cycle at this point. But again, if fundamentals are pretty good out there, and if we do get stimulus with this tax plan, do we have to have a recession just because we're on that cycle?
Yeah, we don't have to have a recession, but literally what I find interesting after doing this for a long time is, again, expect the unexpected. One of the things that is very difficult, obviously, for economists to forecast is a recession. So the numbers are good, the numbers are good, the numbers are good. Oops, the numbers are bad. We had a little flash of that last spring when the May unemployment report was light. Then last summer we saw the August and September manufacturing numbers turn down a little bit on the unemployment. So, around the edges, there's a little bit of crumbling. One of our theses that could lead to a recession in 2018 is, again, going back to higher oil prices. If you get higher gasoline prices with an already strapped consumer, that could cause the consumer to start to pull back. So it's one of those things where the wealth effect this year, we think, has really taken hold. People have seen their 401ks go up, their investment portfolios go up month after month after month. And if you have a period of time where they're not doing so well, maybe the consumer, pulls back. Right.
Well, I also think going forward, looking at economic data, wage growth is really going to start to matter because we are at essentially full employment, right? So you're going to need to see, okay, is the consumer going to catch up with this? It's one thing to have everybody employed, but are they keeping up with the cost of living? So I'm also interested to see how consumer spending trends are going to play out for holiday 2017 because they seem quite strong.
Right.
And we saw that rotation back into retail. And to wrap this up, valuations will matter in 2018. I agree with you there, and I think that's where we could see that sector rotation. Even if you look at biotechs and biotech names, for example, they are actually trading at lower valuations than many other sectors. Retail is one of them. Energy, with crude stabilizing a bit. So in my opinion, I don't think we'll necessarily see massive volatility back in the market, but certainly sector rotation for those reasons of valuation mattering.
You're correct, Jill. I mean, you could see, the difference between the worst performing sector, energy, this year, and the best performing sector, technology, was over 30%. Something, again, unprecedented. Just that sector rotation. You could have the markets trading sideways, but beneath the surface have that tremendous sector rotation, which is really where the returns come for 2018.
All right, let's wrap up with my favorite segment of the episode, RIA strategy. And what we're going to focus on for December, because it's the month to give thanks, is thanking your clients. This has to be the most important part of what RIAs do for their business.
I think it really is, Jill. And one of the things that I find extremely interesting, I mean, back when we were on the other side of the fence in the Wirehouse days, our team was one of the few teams that would do some type of client appreciation dinner. And we kind of got the idea, we have a lot of retired executives, and we asked them what they missed the most. about retirement from working, and they said, you know what, we used to love the Christmas parties we'd go to. Our wives would dress up. We'd get to meet everybody else and their families. And so we started doing client appreciation dinners in the month of December. I think it's really important. These are the people. Yes, it's a dollars and cents business, but it's also a people business as well. And I think a lot of RIA firms miss thanking their clients. I think we do a very good job at our firm. We've done the client appreciation dinners. Last year we had a little party at our office, and we took everybody to a Christmas show. Everybody had rave reviews doing that. But again, clients are literally the sole focus of how we make our money, and you really need to thank them. We came up with something this year very unique for those clients that can't make the in-person appreciation dinners, etc. Gobblegobble.com, Greenberg smoked turkeys. We got rave reviews. Clients that were out of the area, we sent the turkeys to them, and we had clients calling us up going, oh, we got that just in time when we had family over, etc. It was one of the best gifts we've gotten in a long time. So again, we think it's really important to appreciate those people that, we do business with and that are our clients.
I also think it's interesting because if you do have the chance to spend time with your clients outside of the office setting, you actually get to know more about them as well. And that could help with their planning too.
Very, very important point, because everybody talks about trying to get the intergenerational, where we have situations where we have the grandparents, the parents, and the kids as clients now. So once they know, the parents know who you are, there's a higher probability that obviously you're going to keep the money for the long term, but you can also help them do planning as far as how they're going to be giving their money away, whether it's year-end tax planning, 529s, etc. It's very important to get to know everybody in the family.
All right. Well, thank you very much for joining us at Nasdaq HQ. And as always, thank you for joining Chris and I. We will be back for January's RIA strategy update on Thursday, January 25th. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.